'Tis the season to give. Most of us like to give. It kind of warms our heart, especially this time of year. And I think most of us know you get a tax deduction from giving, but do you know how to maximize that tax deduction? That's what we're going to talk about today. First of all, though, who's giving? You know what? Mostly you and me. Individuals, 72%. Foundations, another 15%, bequests and corporations, but it's mostly you and me. So let's figure out how to maximize our gift at year end to get the biggest bang for the tax buck. Give while you're living than after waiting till you pass away. Because when you give while you're living, you get a current income tax deduction on your return. So let's talk about the best way to do that. You can do it through cash and check. You can do it through non-cash items. I don't know, like sports equipment, purse, clothes, whatever. Could be appreciated stock directly from your IRA. Could be a split interest gift. That sounds complicated. We'll try to make that simple. So right off the bat, bunching. This is, there's an itemized deduction, there's a standard deduction. You get to take the higher of the two on your tax return. Itemized deductions, $25,000 roughly for married people. If you're under that, you get the standard deduction, and if you're giving away donations, you're not getting any benefit. So what you might want to do is make a big deduction one year and then not the next year to get over that. Some people use a donor advised fund with this technique, which works really rather well. This is where you set up an account called a donor advised fund. You, the donor, gives cash or property. It eventually goes to charity, but it sits in this donor advised fund, and in that fund you get a donation deduction the year you put the money in or the appreciated stock in, but you get to decide what charity gets it over time. So the way this kind of works is you put the money in, you get a tax deduction now, charity gets the money later. It's a really good strategy. Notice I say you can give away property. It's best to give away appreciated property because you don't have to pay tax when so you don't have to sell that stock or whatever it may be. Because you get a tax deduction for what it's worth on the day that you donate it. You can do a contribution up to 30% of your adjusted gross income, but you don't have to pay the tax on that. Here's kind of a way to illustrate that. $10,000 stock that you bought for $1,000. What if you give that away? What does that mean to you financially? Well, first of all, you get a tax savings of $3,700, so that's your money in your pocket, less taxes. But you also didn't have to pay a capital gain tax had you sold it. So really there's a benefit of almost $6,000. Here's another one. If you're over 70 and a half, you can give directly from your IRA. $100,000 per person, $200,000 for a married couple. That's a really good one. It can count for your required minimum distribution. Charitable remainder trust. This is a little trickier, but if you have appreciated property or a highly appreciated stock, you can set up a trust, charitable remainder trust, CRT. And you set up the trust, you put the property in, the stock in. The trust sells it, it pays no tax because it's a tax-exempt entity. You get payments for life. These are designed where you get 90% of the payments back to you, but there's no tax to pay up front. Whatever's in that trust when you pass away, though, goes to charity. Charitable gift annuity. This is if you have an organization that offers this, like my dad did with the National Park Service Foundation. You give them money, and you get the money back with interest, and you get a charitable donation as well. So it's not a bad thing. You can do that on 1 or 2 lives. Be aware that when it comes to charity, there are limitations and there are other benefits that I mentioned. So first of all, what if you don't itemize? You can actually still take $300 as a deduction as a single taxpayer, or $600 above the line, and still take that standard deduction. 100% of your income, that means that when you donate money, you can take a deduction. You have to have income of $100,000. You could donate $100,000. You could zero it out if you want to. Most people don't want to do that much, but you could. 30%, by the way, when it's capital gain property, appreciated property. And then finally, I want to tell you that if you give away so much that you don't qualify for the deduction, don't worry about it, because you get to carry it over, and that carryover goes for 5 more years. By the way, this $300, $600, that's through 2021, as well as the 100% limit on eligible cash contributions.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.